Welcome to Catalysts. I'm Madison Mills. We are 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, markets looking to rebound after the S&P 500 officially entered into a correction. Can the tech trade revive the downturn? We'll discuss that. Plus, crypto volatility front and center this week. We'll talk about the outlook for Bitcoin and whether crypto belongs in your portfolio for our weekly FA Corner. And what President Trump's 200% tariffs threat means for U.S. wineries. We'll discuss with the CEO of Wolfer Estate Vineyard. Half an hour into the start of U.S. trading, let's get a check on the markets brought to you by Tasty Trade. Taking a look here at the major averages. You've got stocks looking to make a rebound after the S&P 500 officially entered into correction territory, down 10% from its prior high. You can see the S&P down, up about 0.9%. So used to saying they're down. Now we've got the NASDAQ up nearly 1.3%. Let's flip the board over to the bond market. The bond market doing what it was supposed to do on Thursday. We had yields rising. We're continuing to see that this morning after you're seeing those prices moving to the downside, a little bit of a sell-off. Not too much, though. You've only got your 10-year yield up by about 4 basis points. But let's look at our final risk-on indicator here with the likes of Bitcoin still moving to the upside, keenly above that 82,000 level that we have just been hovering around over the course of the last couple of days. So much volatility for this particular asset, though this morning you've got it up a little over 2%. We are getting fresh econ data right now. University of Michigan consumer sentiment, the preliminary reading from March coming in 57.9 versus 63 expected. I just want to break this number for you here. This is the lowest reading since November of 2022. The median estimate of 63, forecasting range from 60 to 65 from 47 estimates here. Expectations index falling to 54.2 versus 64 last month. That's the lowest reading since July of 2022. So a huge move to the downside here. The expected change in median prices during the next year rose to 4.9%. That means that people think that prices are going to rise by nearly 5% next year. The prior reading was just 4.3%. That is the highest inflation expectation since November of 2022. And the expected change in median prices in the next 5 to 10 years also rising to the highest level since February of 1993. Now, we've been talking about this. Consumer sentiment, it's not always a key data point because it's not something the Federal Reserve factors into their rate cutting cycle, but it matters a lot right now because there's been this question about whether or not we're seeing a consumer spending slowdown. And this data indicates a consumer that is worried about the path forward of inflation. Will we see consumers cutting back on spending off the back of this data, off the back of policy? That is what today's UMich numbers potentially paint a picture of. Of course, we're going to continue to cover these numbers for you. Well, the Magnificent Seven is in the red this year. Meta, Apple, and Tesla, the worst performing of the bunch so far, with Tesla off 46% from its prior high. Meta and Apple both down 18% from their highs as well. So what's next for the tech trade? Joining me, Brian Belsky. He's the Chief Investment Strategist over at BMO Capital Markets. Brian, great to have you on here. I just want to get your take specifically on the Mag 7 here. Can investors still trust in the tech trade?
Oh, good morning, Yahoo. Good morning, Madison. Yes, the answer is yes. Just because stocks go down doesn't mean that they're bad assets or bad companies. Remember, 2022 was a very tough year for tech, given what happened in 2021. God giveth and God taketh away. And then we had this huge rebound in 23. 24 was about the AI trade. And maybe these tech stocks got ahead of their skis a little bit. But at the end of the day, these are monster companies that define the growth trajectory for the United States stock market. They are not going away. We believe that as we have for over 10 years, these large cap technology stocks, some of which you listed, by the way, some of those in the Mag 7 are actually consumer discretionary and communication services stocks, technically. We believe these now are the new consumer staples, quote unquote. Doesn't mean that you need to overweight those names. That's actually not our call. Our call is to overweight technology in general and to create a barbell. What's the barbell? You are equal weight or slightly underweight select names within the Mag 7, and you are overweight other areas in technology. That's called portfolio management tracking error. And that's how we think we're going to get risk-adjusted returns from here.
So what would you say is the single name in the Mag 7 that is the most viable dip right now?
Apple. Apple's the best company in the world. It's got more cash than several countries out there. I think this notion of the Siri not being ready in terms of new AI, people are just using excuses to sell the company. This is a company that you buy on dips historically. It works until it doesn't work. But at the end of the day, this is still a company that defines innovation and great management and great products for the United States. So I would put Apple as the number one buy on the list in terms of trying to buy the dip.
And are there any repositioning moves that you are making off the back of this? I know that you hold all members of the Mag 7 except for Meta. At what point is the discount for Meta too good for you to ignore?
Listen, if we look at Meta and we look at how it trades from a fundamental and price performance perspective relative to Google, we're putting our money into Google. You don't have to own everything, Madison, by the way. Meta is a name that we would look at maybe if we see additional downside. But we've only recently, in terms of October, bought Tesla, and we have a very small position. We'd actually love to be able to buy more of that. We typically make changes at the end of the month. So we're investors. We look at positions and performance on our portfolios that we run for our great wealth management channel. We run just over $10 billion. And we typically make changes at the end of the month to kind of dissuade from big amounts of turnover. But we think the reaction in Tesla is massively emotional. We're letting feelings versus facts. And we do believe that this is a great buying opportunity longer term for a company that is just an amazing technology company.
Brian, I'm fascinated. Let's talk about Tesla for a second, because I've been fascinated by this story here. And just the degree and speed of the sentiment shift on Tesla feels like something I personally haven't seen. You've obviously been doing this longer than I have. I did a TikTok about this week. I have 170 comments from people who have said that they have turned bearish on Tesla. At what point does the fact that consumers don't want to be inside of a Tesla start to weigh on the company?
I think, again, everybody needs to slow down in terms of their emotions on Tesla. This has been a couple of months. Let's just take a deep, deep breath. This is a company that's been in the works for decades, that it continues to exude technology prowess with one of the smartest, most brilliant people in the world. Whether or not whatever your political connotations is, again, you need to set politics on the side and take a look at what that man has done with respect to his companies and his technology going forward. We do believe that Tesla remains the best EV out there. We do continue to believe that its technology is the best with respect to Tesla robotics or driverless cars, and or what he's done for Starlink and SpaceX. So I think this notion of consumers not saying they're going to be in a Tesla anymore, or some of the actions and issues that they're displaying, I think is quite frankly deplorable. And obviously, I obviously don't agree with that type of behavior. But at the end of the day, this is a great company, and we do believe that it will be around for the next 5, 10, 20 years.
And I know you mentioned in your note that selectivity is critical when it comes to the tech trade. What are some of the names that you are looking at outside of those big tech names we talk about all the time where you see opportunity?
Well, we have the very good fortune of running what we like to call 8 separately managed accounts and 1 ETF and 1 mutual fund for BMO Wealth Management. And Oracle's a name that we've owned in our value portfolio for several years because it was a cash juggernaut. And then it quickly turned into a great AI name because of that cash and because of the R&D that it did with respect to surrounding AI. So Oracle would be our largest overweight outside of the Mag 7. Now, it's still a pretty big company, but it's nowhere near what we've seen in that. We also own a company called Broadcom in our dividend growth portfolio that has been an amazing company longer term. Qualcomm we own a little bit of, and we are bottom fishing in AMD because we do think that AMD is to NVIDIA what Coke is to Pepsi. And we do believe that's a name that can do very well and actually has been unjustly beaten up here over the last 6 months.
And I want to end kind of where we started, Brian, on how the sell-off in tech is making you think differently, perhaps, about where the market is heading. Does the tech sell-off alone tell you that we are heading toward a bear market?
No. In fact, any second now, we're publishing a piece in the public domain talking about this correction. And I think that so many of my compatriots, colleagues, competitors are basing their opinions on what they don't know. And it's really, we're in uncertain times. And the uncertainty we all know is all about that T word. I'm not going to mention it because everybody talks too much about it. But what do we know? We know three things. Number one, as you said in the top of the broadcast, that the S&P 500 did finally academically enter into a 10% correction. We wrote about the anatomy of a correction that typically and historically since 1950, these types of corrections that happen this fast go right back up and recover just as fast, if not more. Thus, we remained very comfortable with our $6,700 and $275 targets in terms of price and earnings, respectively, for the S&P 500. That's number one. Number two, in terms of fundamentals, they're still flashing green, not yellow, not red. Everyone's starting to talk about a growth scare based on no absolute data that's showing that. And we have some cool charts that show earnings growth in the report. Lastly, we're not an economist, nor do we play one on TV, but the major economic data that we look at are not showing disintegration. On the consumer sentiment side of things, you mentioned November 2022. You know that was within 2 weeks. That was 2 weeks after the market bottom in October of 2022. That was the start of the new bull market, started in October of 2022. That was the bottom. So consumer sentiment, macro data is typically lagged. We would say be very, very cautious with respect to those types of things. And as long as everyone has become so bearish, we've actually become more and more bullish. So we feel very, very good to be a fundamental investor right here, right now.
Hey, I love to get the optimism, Brian. Thank you so much for coming on. You know we love talking to you. Really appreciate you making the time for us this morning.
Thanks so much.
Well, the U.S. will likely avoid a government shutdown as Senate Minority Leader Chuck Schumer said he and other Democrats will support the GOP spending bill, funding the government through September. So after today's vote, the next thing on the docket for the Republican-controlled Congress is extending those 2017 tax cuts and raising the debt ceiling. How does the passage of the stopgap bill complicate these fights? Joining me now, we got Henrietta Treyes. She's the Director of Economic Policy at Veda Partners. Henrietta, it's great to speak with you. Talk to me about how what we've seen develop in the past 24 hours shifts your thinking, if at all, on what comes next for that tax bill. What is the unfolding of the past 24 hours when it comes to Chuck Schumer's capitulation tell you about what comes next?
Yeah, all the attention has been on the Democratic Party and where they're going in terms of the shutdown and deciding not to pick a fight right now with President Trump and the Republican conference. But the really interesting and more exciting meetings have been happening at the White House with Republican leadership who's trying to write this big tax bill and President Trump. And what's emerged over the weekend is that they are increasingly getting the president comfortable with pretending that the cost of extending the existing tax rates doesn't cost any money. This is something called the current policy baseline. It's super wonky, but it creates a pathway to massive deficit increases of $4.6 trillion just to keep rates flat that they're going to pursue going into the reconciliation bill that they're writing right now. We're still months away from seeing the text of that bill. Indeed, they're not even going to have a budget resolution until closer to Easter, but that's the direction that they're headed right now. And that's the most interesting dynamic in DC today.
And Henrietta, I keep hearing from investors that we are starting out the first half of the year with policy vegetables, and then we're going to get dessert when it comes to tax cuts. But it seems like the market was kind of wrong on their optimism surrounding tariff policy. Is the market also going to be caught off sides when it comes to their optimism about these tax cuts?
Absolutely. I think that's a really important message that is being missed by the markets right now. There are no tax cuts. There is an extension of the status quo. And that's, in fact, the entire argument behind Treasury Secretary Scott Bessent and Howard Lutnick and President Trump and Republicans on the Senate side saying we're actually not stimulating the economy at all. We're not spending any new money. So let's use the current policy baseline. This doesn't cost anything. That is de facto an admission that the bill they're working on is not a tax cut. So there are a lot of vegetables, substantial deficit increases, these tariffs, and no tax cuts. There are a couple pieces that they're going to try to add on, no taxes on tips, for example, but that's $175 billion in additional deficit financing. And unless you earn tips, it doesn't benefit you. So I think there's a long way to go for the market to understand that there is no sugar, there's no dessert. It's vegetables from here on out.
So what do you think, what's the misunderstanding here? Because I completely understand what you're saying, that it's just an extension of tax cuts that were already in place. Why are investors so bullish about the idea that there's going to be some additional tax cut that's going to be beneficial for public companies?
I think that there is a focus on deregulation, which, if you're in the crypto industry, might exist for you. But besides that, there's not a deregulatory immediate component that's going to offset tariffs on every single one of our allies and foes alike, 20% on $489 billion worth of goods coming in from China. So there is a very effective message from President Trump that there will be tax cuts, but that is not the reality of what is behind the legislation that they're working on. And when, Kevin Hassett or Peter Navarro comes out and tries to sell the American public on the idea that tariffs are tax cuts, which is their newest line, it's effectively an alternate reality. And tariffs are obviously not tax cuts, but that's the message that they're sending.
Yeah, Henrietta, let's just go back to basics on that for a second. I know we've talked about this a ton, but for our audience listening, can you explain that? Because even the press secretary herself this week saying that exact line, can you confirm and explain to our audience why tariffs are not a tax cut?
Right. Take Walmart. It's a perfect example. 60% of Walmart's goods come from China. They have a 2% margin on their goods. If you put a 25% tariff on, or the 20% that's already been imposed over the last 5 weeks, you cannot offset the tariff hike without passing the cost on to consumers. That means everything that you buy at Walmart is now more expensive. And this ranges from the bottles of beer that you buy and the aluminum that are now tariffed at 25% to the umbrellas you need to weather the storms of the spring. It is across the board. And on, again, friends and allies alike, now on trillions of dollars worth of global trade. So these are cost increases to the U.S. consumer. In no way, shape, or form are they tax cuts.
And lastly, I want to end on something that we've seen over the past 24 hours, kind of where we started the conversation. Chuck Schumer somewhat capitulating to the Trump administration and saying that a shutdown would leave sort of some checks and balances off the table for Trump and for Elon Musk. And so Democrats had to get on board with this GOP spending bill. Just curious what that tells you about the state of our government right now. That feels like something very important that I don't want us to kind of brush over.
I think a lot of this is to do with Doge and the ability of Elon Musk and the American public to go in and say, hey, there's obviously too much spending at the federal level. There's tremendous amount of support for that. And I think that's why President Trump was so willing to walk into this shutdown potential fight. There is a narrative that American public believes that the federal government is bloated and Doge is doing, the Lord's work by getting in there and cutting spending from wherever they can. And so that was a narrative that I think Chuck Schumer did not want to play into. There are plenty of Democrats who are furious right now, talking about primarying Chuck Schumer in New York during his next election cycle. But I think the overall takeaway is that the Democrats routinely fold like lawn chairs when it comes to shutting down the federal government. So in this case, they did it as well, which is in line with expectations.
Repetition of history. Henrietta, thank you so much, as always, for your insights. We love having you on. Appreciate it.
Thank you.
We'll have all your markets action ahead, so stick around for more stocks still in the green this morning. You're watching Catalysts. Let's take a look at some of today's trending tickers. You can scan your QR code to track the best and worst performing stocks of the day with Yahoo Finance's trending tickers page. First up, shares of Ulta Beauty rising after beating the street's expectations for the fourth quarter. That's despite issuing a cautious outlook for the current period, citing consumer uncertainty as well as internal challenges. Ulta expecting comp sales to remain flat to rising just 1% in 2025, lowering its annual earnings forecast, anticipating between $22.50 and $22.90 a share. The stock up nearly 9%. And investor Bill Ackman, billionaire investor, cutting his stake in Universal Music Group, shares taking some losses of close to 8%. Ackman confirming his hedge fund Pershing Square is trimming its position from about 27 to 17% of its total holdings. That's according to Bloomberg. Pershing Square will sell 50 million shares priced at $29 each in a deal valued at $1.4 billion. Universal Music Group down 7.5%. In a post on X, Ackman calling UMG, quote, one of the best businesses we have ever owned, claiming the company has outperformed the rest of its portfolio year to date. And finally, Chipotle getting an upgrade to buy from hold at Loop Capital Markets. The analyst raising its price target to 65 from 58 bucks, citing valuation, his view of improved comp sales trends, and a very management tariff risk as well. Loop says Chipotle only sources around 2% of its total inputs from Mexico. The analyst saying the stock's recent drop represents an attractive buying opportunity. EV charging company Blink Charging missed its estimates for its fourth quarter revenue, due in part to a steep pullback in product sales, which fell 49% on an annual basis. The company expects sales to improve by the second half of 2025, but predicts flat growth in the first half of the year as the EV industry adjusts to the new administration. Joining me now, we've got Mike Battaglia, Blink Charging CEO. Mike, great to have you on, and thanks so much for joining us this morning. I just want to start with you on how you're looking at the year ahead, given the policy uncertainty of this administration. We obviously know that the Trump administration is rolling back government subsidies for EVs. What impact does that have on your business?
Yeah, thanks, Madison. Thanks very much for having me today. Very happy to be here. So, first of all, Blink has built our company not on government subsidies and government policy. We built our company on a foundation of commercial success. So we work with commercial enterprises across multiple vertical markets. Now, that said, is there noise in the market? Is there turmoil? Were there certain programs that were under the Biden administration that are now paused under the Trump administration that would have been beneficial? Yes, that's for sure. But the one thing I want everyone to remember is that this industry is fundamentally strong. EV sales are still very strong, both here and in Europe, where we have a significant presence. And the final point to this is that ultimately the consumer is going to decide how the EV electric vehicle market progresses. So it's not going to be government policy. It's not going to be any external factors. It's going to be attractive EVs that are launched by automotive OEMs, and it's going to be consumers that are choosing or not choosing those products to buy.
And talk to me about how you are thinking about the impact of Tesla moving forward. You've obviously seen a sales slump in Tesla vehicles, obviously domestically, but also more potently abroad. Does that hurt your business?
No, I mean, I think what you're seeing in the market actually are the other OEMs, not Tesla, that are introducing a number of new electric vehicles into the market. I think in 2025 alone in the United States, there's going to be roughly 40 new electric vehicle launches in the US. So what's really happening is consumers are perhaps moving away from Tesla a bit, and that they're choosing to consider other EVs from other OEMs. The other thing is that currently Tesla drivers make up a significant portion of consumers that actually charge on our charging network. So that's just one aspect of it. But what we're seeing are market share gains among the other OEMs. So, our charging stations are equipped with universal plugs. So whether it's a Tesla driver, whether it's a non-Tesla driver, for us, we're agnostic in that regard.
And obviously, you are also the leading EV charging network in Europe. Are you investing more abroad than you are domestically, given what we've talked about and some of the challenges?
Yeah, good question. And just to clarify, we are the third largest EV charging network in the US and a leading, not the leading, but a leading EV charging market in Europe. So, we're not managing our business on short-term vagaries in the market. We're building this company for the midterm and long-term success. Now, has some of our effort and some of our focus shifted a bit more to Europe? Yes, it has. There's a steadier state there. There are interesting opportunities that we're seeing in Europe, especially in the UK, with a government-funded program called LEVI, L-E-V-I, which is actually similar to the US's program of NEVI. So we're well-positioned there. We're well-positioned in Belgium, where we have a very strong presence. So the short answer to your question is yes, we're focusing a bit more resources there. But we are still, I want to be very, very clear, we are still very bullish and optimistic on the U.S. market.
So what do you think is the biggest tailwind to EV adoption in the United States, just given the slowdown that we've seen? And I know you saw a huge pop in 2023 when we all saw that huge pop in EV sales. And of course, that's come down from there. But what is the next big catalyst for EV sales that would be good for your business?
Yeah. So first of all, our business is comprised of two things. We both sell product, and you highlighted that in your chart at the intro where our product sales are down. But the real bright spot for Blink and where our strategy is moving is to become an owner operator of EV charging stations. And our owner operator revenue in the fourth quarter was up. Actually, for the year, it was up 32%. For the quarter, it was up over 25%. So we're seeing tremendous growth on the owner-operator side of the business, where we own the station and we earn a return on investment on the electricity that goes through that station. So to answer your question, Catalyst, it is for us to continue building upon that owner-operator model, have less reliance on the product sales side of the business, and quite frankly, take advantage of the electrification of transportation. And that is an inevitable outcome. It does not mean that 100% of vehicles on the road are going to be electric. Does it mean that a significant percentage of them will? Absolutely. And I also don't believe that the United States is going to give up the EV charging market to China. So again, I think this is temporary. I think things will settle down. I think we'll see that in the second half of the year. And again, we just remain, very optimistic for the market. We remain optimistic for Blink.
All right, Mike, thank you so much for making time for us this morning and giving us that outlook. We really appreciate it.
Yeah, thanks, Madison.
We've got all your markets action ahead. Stay tuned for more. You're watching Catalysts. It's now time for some of today's trending tickers. Scan the QR code to track the best and worst performing stocks of the day with Yahoo Finance's trending tickers page. First up, shares of Ulta Beauty rising after beating the street's expectations for the fourth quarter. That's despite issuing a cautious outlook for the current period, citing consumer uncertainty as well as internal challenges. Ulta expecting comp sales to remain flat to rising just 1% for 2025, lowering its annual earnings forecast and anticipating between $22.50 and $22.90 a share to come. Those shares up nearly 9%. And billionaire investor Bill Ackman cutting his stake in Universal Music Group. Shares taken some losses, down nearly 8% right now. Ackman confirming his hedge fund Pershing Square is trimming its position from 27 to 17% of its total holdings. According to Bloomberg, Pershing Square will sell 50 million shares at $29 each in a deal valued at $1.4 billion. In a post on X, Ackman calling UMG, quote, one of the best businesses we've ever owned, claiming the company has outperformed the rest of its portfolio year to date. Finally, Chipotle getting an upgrade to buy from hold at Loop Capital Markets. The analyst raising its price target to $65 from $58, citing valuation, his view of improved comp sales trends, and a very manageable tariff risk. Loop says Chipotle only sources around 2% of its total input from Mexico. The analyst saying the stock's recent drop represents an attractive buying opportunity. Those shares moving to the upside. Crypto has been on a wild ride the past 6 months, jumping in November on President Trump's election victory. Bitcoin surging past the 100,000 mark in December, but since we've seen the cryptocurrency fall as low as the 76,000 level, currently trading around the 83,000 level. Here to dig into this, as part of our weekly FA Corner brought to you by Capital Group, we've got Tyrone Ross, principal and founder of 401 Financial. Tyrone, great to have you here. So I guess if you are a Bitcoin holder, you're somewhat used to or should be used to a significant amount of volatility, but we've got a lot of it lately. What is your message to investors who haven't gotten into crypto yet about the opportunities in the space despite some of the volatility that we've seen?
Yeah, volatility comes with it. It's a temperamental teenager, right? 17 years old. But I think for folks that want to invest in it, I think the first thing I would say is look to make sure you have a long-term time frame. If you're not willing to hold it for at least 5 years and deal with 30% drawdowns, which are the norm, you should not do it. And I think mainly to make sure you are an investor. There's a difference between a trader and an investor. And unfortunately, the crypto space is pervaded with traders and not enough investors. And as the asset class matures, I think there will be more seasoned investors that can deal with this volatility. But one, make sure you are an investor, and two, make sure you have a long-term time horizon.
And how long does that time horizon have to be? Because often when I speak with people who hold Bitcoin, they tell me they're never, ever, ever selling under any circumstances. They're just going to transfer their Bitcoin to their kids. At what point should investors consider maybe taking a little bit of profit?
Well, to those people, I say, my mother has a phrase, keep living. Everyone is going to need dollars at some point. So there's prudent points at which you would want to sell your Bitcoin, and you won't interview a bigger crypto hippie, believe me. So I think one, you want to look at this based on goals. How old are you? If I'm 25, sure, I want to hold it for the next 25, 30 years. If I've bought it in my 40s and now I'm 50, maybe I'm looking at selling some off. It all comes back to what your goals are with this and understanding how the market works and how you are looking to have that as part of a broader financial plan for your life. It's not as simple as just buying it and letting it sit there. There should be a plan around it, like all assets.
And when you look at digital currencies, obviously there's Bitcoin, but what are some other cryptocurrencies that investors should be looking at who are interested in the space?
I love that question because I think folks need to make the big distinction. There's a difference between Bitcoin and there's a difference between crypto, right? And there's crypto assets is what I call them. They all fall under that umbrella. There are other coins and tokens out there, tens of thousands, if we're being honest. But I think if you're looking at where there's a lot of one, market cap, two, liquidity, and three, interest, is probably Ethereum and Solana. But I think it all comes back to the mothership first. I think if you at least try to understand Bitcoin, you can understand how Ethereum and Solana and Litecoin and all of those have come after. But I think the main investment that people can make here is really understanding, asking really good questions, reading a ton, looking silly, asking more questions, and then making a small investment amount and seeing what happens.
And talk to me too, just about the regulatory backdrop. There's obviously a lot of optimism around what Bitcoin regulation is going to look like under the Trump administration. How big of a tailwind could that be? And are there any risks regarding regulation?
Yeah, so it is a tailwind. You would think it would be a tailwind now. You're not seeing that in the price, but I think it is because as a builder in the space and as a financial advisor and someone who speaks often, it's brought a lot of interest in. Even our legal at 401 Financial said, okay, this opens the doors to some of the things that you want to do. But I break it into two buckets after that. If you are an advisor or in the wealth management space, we would love guidance from the SEC and the CFTC. If you were listening, joint guidance would be really nice. Right, Paul Atkins still needs to be confirmed. That would be helpful. We can see finally get some clarity on what are securities and what not. So that's from the institutional wealth management side. From the retail side, they are talking about redoing some of the DeFi broker rules, changing some of the tax implications, which are starting to go into next year. So I think a retail investor and an institutional investor have different things here that they should be excited about what we've been hearing from the government. But I think there's still a lot of pause because we got to get folks in place. We got to see how this plays out. There's been a lot of talking, but we need to see these things set in stone. And then folks will allocate and position themselves accordingly. And honestly, I think that's why you're seeing the jittery markets right now.
All right. Really appreciate you joining us this morning, Tyrone. Thank you.
Thank you for having me.
Coming up, how the ultra wealthy are approaching this week's sell-off and the future impact. But let's just take a look at the market action before we head to break. You've got your S&P 500 still up over 1%. Your tech-heavy names carrying the majority of the gains here. You've got your tech-heavy NASDAQ up 1.3%. Maybe this is a sign that we're seeing a bias toward dip buying in this market, given the sell-off that we've seen, the volatility that we've seen. You've also got the bond market really taking those inflation expectation data points in stride, keenly focusing on what's happening in Washington. And as you can see, that is continuing to lead to more gains on your stock market. More when we come back. How are the ultra wealthy responding to the recent market volatility? Alti Tiedemann Global is a wealth manager with $77 billion in assets under management. The firm is out with its annual social product Progress Index and its outlook on where private capital can drive impacts. So joining us to discuss all of this, we've got Michael Tiedemann, Alti Tiedemann Global CEO. Michael, great to have you on. We're going to talk about the Social Progress Index, but I would be remiss to not speak with you about all the market action that we have seen this week. Where do you think the market is heading? Is this the beginning of a bear market, or are we about to see just more movement to the upside like we've gotten used to over the last 2 years?
You're asking me to make a market prediction that most people would love the answer to. First of all, thank you for having me. Second of all, I think it should be no surprise that there's increased volatility in this year, and there are some decisions being made and discussed politically that are obviously creating a lot of that volatility. But it's the back of 2 years of really outsized returns and a narrowing of really what is driving the market. So volatility should be expected. In terms of how our clients are responding, we have diversified portfolios. Our client portfolios tend to have about a 0.5 beta to the market. So this is never a comfortable time. Certainly a lot of people asking questions and making sure. But when you own high quality assets, high quality risk assets, this is exactly the type of environment. And you're reminded as to why you own those.
And how have you been advising clients through this moment? Are there any assets you've been advising people to get in or out of right now to kind of hedge some of the volatility?
We rebalance portfolios. So as you go through, the last few years, there is a rebalancing that naturally occurs, and there's been substantial repricing in high quality fixed income as an asset class. So we have gone from 3 years ago being dramatically underweight that asset class to now more in balance than we have been certainly for the prior 10 years. And then we have a lot of diversifying assets and a lot of assets in private markets. So strategies like private credit and whatnot that are not impervious to market downturns and challenges. And we think there'll be cycles in the future that will be more challenging in spaces like private credit. But however, these are great diversifying assets. And obviously, other assets like gold can be very helpful at points like this.
Yeah, and Michael, our audience of retail investors have been filing in a lot of questions to us about private credit, about the potential of private credit ETF investing in particular. How do you think the investors who maybe don't have the investor hygiene of the folks that you work with, earlier stage investors, how should they be thinking about the opportunity associated with private credit?
If you've gone through any credit cycle as an investor in history, one of the most critical elements is asset liability pairing or not having a mismatch of asset liability. So this is the structures in which you're investing and the quality of the firms in which you're investing are critically important. There will be economic cycles. That is the only thing that is guaranteed. But when you have a mismatch or a structure that has too much liquidity afforded to investors and does not align with the duration of the underlying loans that are being made into the companies, and if it's with the wrong firm, you're taking risks that you likely won't understand until it's too late. So we would urge caution about a structure that offers too much liquidity. And also I would really orient towards the highest quality managers in the space.
And let's talk about your Social Progress Index here. I know that you are calling on private capital to really prioritize social progress through the likes of DEI initiatives, gender equality, for example. How are you pitching that to people given the backlash that we've seen to DEI initiatives in particular from this administration?
Yeah, this is not a DE&I initiative. Social Progress Index has 174,000 data points. So what this really is an incredible data set. And when you start reviewing data and when large families that are looking to make investments into areas where they believe they can drive change, that can be regenerative agriculture, it could be climate solutions that are scaling and carbon sequestration, gender equity investments. These are all things that the most important data, aside from the returns that are driven, is the non-financial data. And that is where historically there was a lot of great intent in people making investments within the impact space, but there wasn't really the capture of that data. We now have entered a phase where there is data coming back to families. They can actually see, first of all, they're getting a return on their investments, and that is competitive with capital markets. And then they're able to generate return and recycle into those spaces if they're actually seeing the impact that they sought in the first place. So that, just to be very clear, this is not a DE&I initiative, and this data set is robust as any. It points out a lot of the issues that societies across the world have been facing: housing, cost of food, water quality. These are all healthcare costs, education costs. These are all systemic issues there are solutions and investable solutions that are available, and that's what our clients are really seeking.
And talk to me too about what the data show about voter dissatisfaction. What does that look like?
It's linked. When you have inflation or stagnation in wealth or declining healthcare solutions or increasing healthcare costs in societies, I chair a board of a charity here in New York City, and we serve 35,000 families. And you see one of the primary reasons why families are in line being served is because they had a family member of a health-related issue, and it really pushed them under the poverty line. So there are societal issues like that ultimately are not easy to solve for politicians and have not been approached historically really in the right way. So that eventually does lead to voter dissatisfaction.
Yeah. All right, Michael, really appreciate you joining us and breaking that down. Thank you so much. Michael Tiedemann, CEO of Alti Tiedemann Global. Thank you.
Thank you.
Let's do a quick check of the markets as we head to break here. You've still got gains to the upside off the back of a record 4 days of losses here. You've got your S&P 500 up 1.4%. You've got your tech-heavy NASDAQ nearing gains of 2%. Again, following the NASDAQ entering correction territory, the S&P 500 entering into a correction. Those names down 10% from their prior indice highs. Will the buying continue into the end of the trading day? That is, of course, the key question. We'll continue to monitor the market moves for you when we come back. President Trump threatened to impose a 200% tariff on alcohol from Europe after the EU placed a 50% levy on U.S. spirits in a rapidly escalating trade war. The president claims that 200% tariff will be great for the wine industry in the U.S. So here to discuss that, we're going straight to the source. We've got Max Roan. He's the CEO of the Hamptons-based Wolfer Estate Vineyard. Max, great to have you. Thank you for making time with us. Talk to me about how these potential tariffs could impact you as a company that does import some of your wines from France, but obviously the majority of your wines are created here in the United States. How are you preparing for this potential 200% tariff?
Hi, Madison. Thanks for having me. The tariffs would be terrible for the industry, both for the American wine producers and certainly for the EU wine producers. So we see a bit of both on our sides because we have about 20% of our production is made in France and we import it. And obviously on the imported side, the tariffs going up by 200% would be just terrible. It would be, I'm not sure if it becomes viable anymore. And those tariffs would be borne on us. We would be importing the wine and paying those tariffs. So that's a direct tax on us as a business. And similarly with our distributor. On our American wine side, which would not be taxed, obviously, it would hurt it because it would hurt the ecosystem, which is a sensitive set of tiers of the market, from producers to distributors to the retailers and restaurants. And the tiers rely on the European wine, and it would hurt our distributors because they would obviously be paying much more for that wine to be imported. And I'm not sure their survival rate in with much of their wine coming from Europe. So we absolutely rely on them to deliver our wine, and we don't want to see them be hurt and have to lay off sales forces and so on. So it would be destructive for the American wine as well.
Max, thank you so much for breaking down that impact. I guess I'm curious, what we've heard from the White House is that this is an opportunity for folks like you to raise your prices and therefore increase your profits. Talk to me about why that's not the case. Well,
the industry is going through a tough time. We are going through a period where people are drinking less. They have many more options from cocktails, from beer to cannabis to California sober to all kinds of designer drugs, and so we're seeing people drinking less wine to begin with. So raising prices would just cause them to simply drink less wine. Already on the menus in restaurants, you've got $20 to $25 by the glass prices, which is already extremely high and causes people to choose cocktails and other products.
Yeah.
And I think raising prices even further would cause them to just drink less.
Max, final minute here. I'm hearing you say things like it wouldn't be viable. How big of a negative impact do you think this could be on the industry, just in terms of potential closures of American vineyards? How much damage do you anticipate being done?
Well, it's hard to say. I mean, we went through the first Trump 1.0 25% EU tariffs, and that was a real struggle for our distributor. But they actually bore through that one and just ate the price increases typically, and thinking that it would eventually change. So that's the hope. Certainly, we're all trying to remain calm, and hopefully this is all resolved without any tariffs. But certainly, if there were a collapse in our distributor network, that would be terrible for the American wine industry.
Are you anticipating raising prices off the back of these tariffs?
I think we would have to, yes.
All right, Max, thank you so much for breaking it down for us. Really appreciate you making the time, and we'd
Thank you,
love to
Madison.
speak with you again as this continues to develop on both sides. Again, President Trump teasing out a 200% tariff on all alcohol from the EU. We're going to do a quick check on the markets before we wrap our coverage here. You are still seeing gains off the back of your S&P 500 and your tech-heavy NASDAQ. Your S&P is up 1.3%. Your tech-heavy NASDAQ up over 1.5% after a record 4 days of losses. The S&P and the NASDAQ in correction territory, down 10% from their prior highs. Of course, the big question, will we continue to see that buying? And you've also got treasuries doing what they're supposed to do when you have stocks moving to the upside. You've got yields selling off just a touch here. That 10-year hovering around that 4.3 level. You've got the 10-year moving up by about 3 basis points here. The bond market continuing its focus on policy as opposed to economic data. We had those inflation expectation numbers coming in showing that consumer sentiment indicating more inflation to come. Coming up here, wealth. Dedicated to all of your personal finance needs. Our very own Brad Smith has you right here for the next hour, so stay tuned for more.